Another tutorial for A-level accounting. My name is Farhan, and in today's lesson, you will practice a past exam question from paper 2 June 2020. You will learn to calculate depreciation using the reducing balance method. You will also learn to calculate the profit or loss on disposal of a non-current asset. The best way you can follow through this content is to pause and rewind as many times as you need to. So with that being said, let's get started. Li Ming is a sole trader and his annual accounts prepared to 31 March 2020. So this means that the financial year of the business that we're working with ends on 31 March 2020. The following information has been supplied. A non-current asset was sold on 30 November 2019 for £7,000. This is what we refer to as the disposal proceeds. The non-current asset had been purchased on 1 July 2017 for £16,000. This is what we refer to as the original cost. Non-current assets are depreciated using the reducing balance method at a rate of 25% per annum. Annual depreciation is time apportioned based on the number of months an asset is held by the business. Calculate the profit or loss on the disposal of the non-current asset that we need to include in the accounts of Li Ming for the year ending 31 March 2020. So what we have to do here is calculate the total provision for depreciation for the number of years and relevant months the asset has been in use within the business. Once we have the total provision for depreciation, we are going to calculate our net book value. Then we are going to use our net book value as the basis for calculating whether or not we have a profit or loss on disposal. So let's get started with calculating the depreciation. Now, the first year of usage for this asset, since the day it was purchased, which is on 1 July 2017, would start on 1 July 2017 and end on 31 March 2018. So this is the first year of usage within the asset. Now, where did I get 31 March 2018? As you know, at the very beginning of the question, we understand that the business has a financial year that ends on 31 March 2020. So once you have identified it, it's very important that you know what to do when it comes to understanding when your year starts and when your year ends. So in this first year of usage, I want to calculate the depreciation using the reducing balance method. So what we're going to do is simply apply the percentage that we are given on the original cost of £16,000 that we have identified here. However, from 1 July 2017 until the end of 31 March 2018, we have 9 months that have passed. How do we know it's 9 months? We count July, August, September, October, November, December, January, February, and March. So that's a total of 9 months in total. This 25% that we have been provided as the rate is an annual rate. As you can see, it's written here, 25% per annum. But in the first year, we know that this asset was used for 9 months out of the total of 12 months that we get in a financial year. Therefore, what we have to do in this case is to adjust it in such a way that this rate of 25% is valid for 9 months out of 12. So that is why we have to do 25% times 16,000 times 9 over 12. Which adjusts the annual 25% into the 9-month rate. So once we calculate that, what we get is 25% times 16,000 times 9 over 12, which is £3,000. That is the depreciation expense for the first year of usage. Now, because we're using the reducing balance method, what we would be doing every time we're using this method is also calculate the net book value at the end of any given financial year. So we want to find the net book value. And how do we find the net book value? So net book value can be calculated by taking your original cost and subtracting any total depreciation. Since we are only at the end of the first year of usage for this asset, the total depreciation is the £3,000 that we have derived. And what we have to do here is start with the original cost of 16,000 and subtract the total depreciation of 3,000, which gives us a net book value of £13,000. Now we're going to move into the second year of usage for this asset. So the second year starts on 1 April 2018 and ends on 31 March 2019. So that's the second year of usage. So in this second year of usage, the asset was used for the entire 12 months, starting 1 April 2018 and ending 31 March 2019. So what we have to do is calculate the depreciation expense using the reducing balance method in the second year. This time, we are going to apply the given rate of 25%, which is already annualized and therefore is valid for the entire year. We are going to multiply this 25% on the net book value that we had at end of previous year. And this is how reducing balance is different from the straight line method. Reducing balance works on applying the percentage that you are given on the net book value as you move from one year to the next. So 25% of 13,000 would give us 3,250. Once we have that number, we can derive the net book value again, which is the same formula as original cost minus the total depreciation. Now, the original cost is 16,000 to begin with. Total depreciation is £3,000 from year one, and then again £3,250 from year two. So we first take away £3,000, which refers to the depreciation expense for the 9 months of usage in year one. And then we take away £3,250, which reflects the entire 12 months of usage in year two. Once we derive that, we get £9,750 as the net book value at end of year two. Now, let's move on to year three. So year three will start on 1 April 2019, and because the asset was sold on 30 November 2019 for £7,000, that is when year three ends for this asset. So it starts on 1 April 2019 and ends on 30 November 2019, which is how many months? So we have April, May, June, July, August, September, October, and November. So that's like 8 months in total. So if you want to find the depreciation expense for the third year of usage, again, we start with the given percentage of 25%, which we apply on the net book value that we have from previous period of 9750. And then because the asset was in use for 8 months in the third financial year, again, how do we know it's been in use for 8 months? You start from the 1st of April and then you end on 30 November 2019. So April, May, June, July, August, September, October, November, and December. So that's 8 months in total. So we are going to multiply 8 over 12, again, to reflect the fact that the 25% needs to be adjusted for 8 months out of the total 12 months that we have in a given financial year. So once we do that, for the third financial year, the depreciation expense that we derive is 1,625. Okay. Now that I've calculated, we want to find the net book value again at end of year three. So how do we do that? Again, we start with the net book value that we have from previous year of 9,750, which had already taken into account any previous depreciations that we had for the first year and the second year. So therefore, if I was to subtract the third depreciation that we have, we can just simply subtract it from the net book value that we have from end of year 2. So we start with 9,750 and then we take away 1,625, which gives us a net book value of £8,125. Okay, now if we recall the disposal proceeds, what do we know? The disposal proceeds was £7,000. That is what we got by selling the asset. Now, right before the disposal, the asset had a remaining value of 8,125. But because we sold it for 7,000, what does that mean? We made a loss of 1,125. How do we know it's a loss? Because we sold it for 7,000, which is obviously less than the net book value that we have at end of year 3, which is 8,125. So let's do that last bit here in the remaining. We don't really have any space here. So loss on disposal equals, this is just logical. So you just need to apply simple logic. You see how the value remaining is 8,125, but we ended up selling it for £7,000 as given in the question. Therefore, we have a loss on disposal of £1,125. All right. So let's move to the second part of the question. The following balances have been taken from the draft accounts for Leeming for the year ending 31 March 2020. So as you can see, we are given the drawings, we are given the profit for the year, and we are given the capital at 31 March 2019. Again, this capital at 31 March 2019 refers to the closing capital from previous year, when our concern is 31 March 2020, which means this capital, the closing capital from previous year, would now be the opening capital in the new year. The depreciation charge for the year ending 31 March 2020 has been included in the draft profit for the year, but the profit or loss and disposal of the non-current asset has not been included. Complete the capital section extract for Leeming at 31 March 2020. All right. So if you want to prepare the capital section extract, it's quite easy. So we start with the opening capital. So the opening capital would be the closing capital from previous financial year, which is £168,950. Then we are going to add any profit that we have for the year, but we got to make some adjustments here. If you remember, we know that any relevant depreciation charge was factored into the calculation of the profit, but the profit or loss and disposal wasn't really factored in. So how do we account for this? Now, let's just go to the working space. So we know that we have a loss and disposal of £1,125. So if we have a loss on disposal, this means that the total expenses of the business will now increase by £1,125. Always remember that profit on disposal is an income and loss on disposal is an expense for the business. So if expenses go up, that would result in a reduction of my profit by £1,125. Again, think about it, everyone. So it makes sense. If your expenses of the business are increasing, then that would reduce your profit. So the profit is going down by £1,125. So how do we account for this here? So we need to subtract 1,125 from the given profit balance of 42,817 to reflect the fact that the business has made a loss on disposing the non-current asset, and that loss was £1,125, which has increased the total expenses by £1,125 and therefore reduced the total profits by £1,125. So what we will be doing here is subtract 1,125 from 42,817, which would give us £41,692. Then we are going to take away drawings, which is given to us as £30,000. Since we are subtracting this, we are going to keep it within a bracket to reflect that we are subtracting this. And all of this together would give us the closing capital at end of 31 March 2020, which is 180,642. So let's have a quick recap. So we started with the opening capital of 168,950. How do we know this is an opening capital? We are given the closing capital at end of previous financial year, which is 168,950. This gets carried forward into the new financial year of 2020 as the opening capital. Then we have added profit for the year of 41,692. The draft profit was 42,870, which had to be reduced by 1,125 due to the increase in expenses. Then we are subtracting drawings, because drawings are going to reduce the profit that Lee, who is the sole trader of this business, will make. And that should all give us the closing capital at end of 31 March 2020, which is 180,642. That's all for today's lesson. I believe you found a lot of value in this content. Don't forget to drop a like and subscribe to this channel. I'll see you in the next lesson.